Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo, and on today's episode, we're going to be talking about two misunderstandings of dividends. So, the reason I'm talking about this today is I was on Twitter the other day and I saw a bunch of people speaking into dividends and essentially how they get an income from that. And what a dividend is essentially a company, and let's just say you own stock in that company. The company has profits, and what they do, they, as opposed to taking those profits and reinvesting it in the business, they take those profits and kick it out in the form of a dividend divided by the amount of people that own shares in their company. So that's what the dividend is. And what people don't quite understand is when the dividend is paid, what happens to the stock price, and then B, the tax ramifications of that. And this is not an episode to say that dividends are bad or dividends are good. It's really for you to understand it, because I think there is too much hype on dividends sometimes and maybe too little hype on dividends sometimes. So this is just a pure educational episode for you all. So let's jump right in here. So as I mentioned before, right? So you own a share of stock in ABC Company. ABC Company kicks out dividends. When they have profits, they kick it out in the form of a dividend to you. So if ABC Company is worth $50 and then they declare a dividend, and let's just say the dividend declaration is 50 cents per share, okay? So you're going to get a 50-cent dividend from that stock. So whoopee, right? You got income from the stock that you own. That's a good thing. The thing that you may not realize is when a dividend is paid from a stock or a fund, the asset price normally goes down accordingly. So in my example, a $50 share of ABC Company that kicks out a 50-cent dividend, now after they kick out that dividend, the share that you own is now worth $49.50. Okay, so don't know what price you bought in at. If you bought in at 40, you're still up $9.50, but you still lost that 50 cents per share. So I just want to make sure you all understand that piece of it. And then the second piece is how the dividends are taxed. And I think this is a big misunderstanding when it comes to this. Okay, so I'm going to share my screen here so you can see what I'm talking about with that. So give me 1 second as I am sharing my screen. So the big thing is taxes, right? So a lot of this is, I don't know, a tax bracket you're going to be in. So we're going to use a married filing jointly tax bracket. Again, this is purely conceptual for you to understand how the taxes work. Make sure you talk with a CPA to look at your own individual situation. So let's just say you've got an income coming in the door of $100,000, right? And the normal $100,000, if all of that is taxed at ordinary income rates, so essentially your taxes, you're in the 22% marginal tax rate, okay? Meaning the last, call it $6,000 that you make is taxed at 22%. Now, if you get a dividend, that is taxed normally at ordinary income rates. So let's just say you got dividends this year and that is $110,000, okay? And the dividend itself was 10 grand over all of the dividends that you received. So at $110,000, really what you're going to do is you're now paying 22% on that extra $10,000. Okay? So 22% on that $10,000, right? That is $2,200 that is going to be owed on the taxes on that dividend. That's how dividends are taxed. Okay? Now, if you just kept, going back to my ABC Company, if you just kept the $50 share and you kept it for at least 12 months, right? And then it let's just say went up by 50 cents or dollar, whatever it went up by, that difference, if you bought in at 50 and it goes up by 50 cents or dollar, that $51 or so, that $1 difference can be taxed at long-term capital gains tax. And long-term capital gains tax, the key here is if you're married filing jointly, right? If you're under $89,000 of income, it could be taxed at 0%, that $1 difference, or in this case, the $10,000 difference, depending on where you're sitting at. Or let's just say you're at that $100,000 figure that I've been talking about here, It'll actually be taxed at a 15% if you're below the I think it's roughly $553,000 of income. So if you're below $553,000 of income, now you're only taxed 15%. That's long-term capital gains tax. So the difference is, again, if we're comparing this, dividends will be taxed at ordinary income rates like I just shared. If you don't get dividends and the share of the price just goes up, then you could be taxed at long-term capital gains tax and only pay 15% compared to the 22% that I just shared with you in my example. Again, it depends on the income and your taxes and all that kind of fun stuff to look at this. This is why it's so important to work with a financial professional and a CPA to make sure that they're looking at the bigger picture and what are the tax ramifications of the style of investing that you're doing. So that's today's episode. I hope it was valuable for you. Make sure to head over to beerandmoney.net, and at the top of the page there, if you have any questions, there's a contact us. It's a great spot to either ask us a question, or if you have a topic on your mind that you want us to chat about, that's a great spot for you to reach out and say, hey, here's a topic I'd love to speak into. Look, we started this podcast to help you think differently about your money so that you can live the life that you want to live. And the best way to do that is really control your finances, be organized with your finances, and have a high level understanding of what's going on. So we hope this episode was helping you with that and specifically around dividends. As always, make it a great day. Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7554008.1, expiration date January 2027.